The closing bell rang about 15 minutes ago, so let's get straight into the scoreboard for Tuesday, July 14, 2026. The S&P 500 recovered to close up 0.38% at 7,543.59. The Nasdaq surged 0.9% to finish at 26,107.01. But the Dow Jones Industrial Average barely gasped its way into the green, up just 9 points to close at 52,508.27.
Right, and that divergence right there, I mean, that is the entire story of the day. It was an incredibly tense session.
Yeah, tense is exactly the word, because if you just glanced at your portfolio app and saw green on the major indices, you'd think, oh, okay, standard summer rally.
Exactly, you'd think it was a breakout. But beneath that index-level calm, we saw some violent capital reallocation. It was basically a massive macroeconomic tug-of-war playing out in real time.
Which is our mission for this deep dive.
Yeah.
We're looking past that surface-level speedometer to really figure out the underlying mechanics. So let's start with the gas pedal, the June CPI data.
Right, the Consumer Price Index.
Yeah, it printed cold to 3.5% annually, and the core month-over-month was completely flat.
And that flat month-over-month reading, I mean, that was the initial catalyst for a massive repricing in the debt market. Heading into the morning, the implied probability of a Fed rate hike was sitting around 42%.
And then it dropped.
And it absolutely cratered to under 17%. The 10-year Treasury yield reacted instantly, dropping down to about 4.58%.
Which, theoretically, is the ultimate green light for risk assets, right?
Yeah.
Lower borrowing costs mean future cash flows are worth more today.
Theoretically, yes, that's the textbook reaction. But this is where the emergency brake gets yanked. Because at the exact same time inflation is cooling domestically, the geopolitical situation completely escalated.
Right, the Middle East.
Yeah. The U.S. reinstated a naval blockade in the Strait of Hormuz amid the rising hostilities with Iran. So West Texas intermediate crude spiked to 79.34, and Brent pushed past 84.73.
Okay, but let me jump in here. If domestic inflation is finally cooling and Treasury yields are dropping, why didn't we see a massive high-conviction buy everything rally today? I mean, I watched the tape at 8:30 a.m. There was this huge vertical spike in the index futures on the CPI news.
There was, yeah.
But it just didn't hold. Like, if yields are dropping, why didn't the real money just step in and ride that wave into the close?
Well, because you have to distinguish between the machines and the humans. That initial 8:30 a.m. spike wasn't human conviction. It was entirely algorithmic.
High-frequency trading bots.
Exactly. They parse the text of the Bureau of Labor Statistics release the millisecond it hits. The code sees inflation is lower than consensus, and it instantly fires thousands of buy orders on S&P and NASDAQ futures. The algorithms, they don't care about a blockade in the Middle East in that specific fraction of a second.
They just trade the data deviation.
Right. But the human portfolio managers, the ones moving the real size, they have to look at the whole board. When the cash session opened at 9:30 a.m., they're looking at crude oil, pushing $80.
And energy is the baseline tax on everything.
Exactly. The Strait of Hormuz handles a fifth of global daily oil consumption. If oil stays elevated, that trickles down to shipping, manufacturing, eventually, the price of goods at Walmart. It threatens to reverse the exact disinflationary trend we just celebrated in the CPI.
So the institutions didn't buy the morning spike.
No, they used it as exit liquidity. They faded the highs. The geopolitical risk of surging energy places a hard ceiling on real, sustained risk-on confidence.
Which perfectly explains the cap-weighted illusion we saw on the scoreboard today. I mean, the Nasdaq soaring while the Dow flatlines.
Yeah, the math is totally deceptive. A massive tech company moving up 2% completely masks the fact that hundreds of smaller stocks are bleeding out. If we look at the internals, the breadth was terrible.
Yeah, I'm looking at the institutional breadth data right now.
Yeah.
Volume on the broad index ETFs, like SPY and QQQ, was actually really muted. And at the closing bell, only 51.7% of individual stocks actually advanced.
So basically a coin flip. The real money was not buying the broad market. If you weren't heavily allocated into mega-cap tech or semiconductors, your portfolio probably felt stagnant or even negative today.
Right, because we saw this ruthless sector rotation. Communication services and materials caught a bid on the CPI relief, but the defensive sectors got crushed.
They were actively abandoned. Healthcare dropped 1.91%, and consumer staples fell 1.38%. Institutions were liquidating those safe havens purely to fund a tech chase.
Because they don't have fresh cash sitting on the sidelines. They have to sell Procter & Gamble just to afford NVIDIA.
Exactly. And that distinction, this environment of structural winners versus structural losers, it leads perfectly into the wildest single stock story of the day.
Oh, man. We have to talk about IBM.
It was an absolute bloodbath.
I mean, cratering over 22% at the close. At one point intraday, it hit negative 25.2%.
Yeah.
And the volume, 64 million shares traded, that is a 551% explosion over its average volume.
That is not a standard earnings miss. That's a structural exodus.
So what was the catalyst? Because that kind of selling pressure is insane for a legacy blue chip.
It was a preliminary earnings warning from the CEO, Arvind Krishna. But it wasn't just about IBM's specific quarter. He basically delivered a terrifying bellwether for the whole legacy tech sector. Enterprise clients are aggressively diverting their capital expenditure.
Diverting it away from traditional software, you mean?
Right, away from the legacy IT consulting and software licenses that IBM relies on. They are starving those operational budgets and pouring every single available dollar into hardware and memory chips.
Just to feed the AI infrastructure build-out.
Yes, it is a total CapEx shift.
Okay, let's unpack this really quick. Is this just a bad quarter? Or are we looking at a permanent structural cannibalization, where companies are literally gutting their day-to-day software tools just to buy servers?
I think the take today confirmed it's structural. Institutions are violently reallocating based on this hardware supercycle. They are yanking liquidity out of the software providers and jamming it into the beneficiaries of the infrastructure build.
And we saw that perfectly in the chip makers. NVIDIA surged 4.1%. Micron climbed 4.8%. And SK Hynix, I mean, they skyrocketed 27% today.
Yeah, because SK Hynix makes the high bandwidth memory that these AI data centers absolutely require.
And it's not even just chips, it's the physical data center space itself. Look at CleanSpark today, ticker CLSK. They surged between 10 and 15% because they secured this massive $6.6 billion AI infrastructure lease.
Right, and the filings say that could expand to $11.6 billion.
Which is just staggering scale.
It is. We are in a completely ruthless, show-me-the-money environment. Tangible, physical infrastructure is being heavily rewarded, and intangible legacy software is getting decimated.
Speaking of ruthless, that show-me-the-money standard definitely applied to the banks this morning, too.
Oh, absolutely. Total bifurcation in bank earnings.
Goldman Sachs was up 8.4%. JP Morgan gained 1.9% on just blockbuster results. But then their peers, Wells Fargo dropped 2.3%, and Citi was aggressively sold off, down 4%.
It just proves there's no blanket buy the dip bid right now. Every stock is evaluated on its own isolated execution.
Right. And if you want to talk about isolated execution and just sheer emotional whiplash, we have to talk about Lucid Group, ticker LCID, because this was the craziest chart of the session.
Oh, the volatility there was unbelievable.
So early this morning, these rumors hit the trading desks that AlixPartners, the turnaround consultants, had proposed a Chapter 11 bankruptcy for Lucid.
And the market didn't even hesitate.
No, it executed the stock immediately. Lucid collapsed 57%, down to an all-time low of $2.37. There were multiple volatility halts just to cool down the selling algorithms.
Because when a bankruptcy rumor hits and it breaks technical support, the capitulation is total. The algos short it, retail panic sells, and liquidity just vanishes.
But then the Lucid Comms team actually got ahead of it. The head of comms issues a direct denial, says AlixPartners is just there for operational efficiencies, and categorically confirms they have sufficient liquidity.
And the reversal was just violent.
Yeah, the buyers rushed in, squeezed the shorts, and the stock reversed to close at $4.62 on an astronomical 153.8 million shares traded.
Which is, what, a 1,000% explosion in volume?
Roughly, yeah. Yeah, imagine being the person who panic sold your entire position at breakfast for $2, only to watch it double from the lows by lunch.
It's brutal, but it really highlights how implied volatility is driving these single stock blowups. Heading into Tuesday, traders were heavily hedged. The VIX-1D, the one-day volatility index, was up 48% on Monday.
Because everyone was buying insurance against a hot CPI print.
Exactly. They bought put options, which drove up the premiums, but when CPI printed cool at 3.5%, that insurance became worthless.
The event risks just vanished.
Right. So the main VIX index got crushed, down 4.37% to 16.41. The volatility sellers feasted today.
But that's the danger, isn't it? A plunging VIX makes the market look calm on the surface, but the 57% drop in Lucid, the 25% intraday crash in IBM, it proves the underlying market is incredibly fragile.
It is extremely fragile, which is why, as we look ahead to tomorrow's open, we need to focus on the structural guardrails.
Okay, so where's the line in the sand right now?
Let's look at the S&P 500 gamma map. The ultimate mechanical floor is sitting exactly at 7,500.
Because there's a massive concentration of institutional put options anchored there.
Right, major put wall. And the ceiling, the mother of all resistance levels, is entrenched at 7,600. The index has tested that ceiling 7 times this month and rejected it every single time.
So we're trapped in this 100-point mechanical box. But what happens if the geopolitical stuff escalates overnight or the data misses and we break below that 7,500 floor?
If 7,500 breaks, dealer gamma flips negative.
Meaning the market makers who sold those puts are forced to start shorting the underlying futures just to hedge their own books.
Exactly. It's automated, reflexive selling. They have to short to stay delta neutral. And that fast flush could drag the index down to the 7,425 to 7,440 zone very quickly.
And we have a gauntlet of catalysts tomorrow to test those levels. At 8:30 a.m. Eastern, we get the wholesale PPI data. We've got the Fed's Beige book later in the day, plus high-stakes earnings from Morgan Stanley, BlackRock, and most importantly, ASML.
Yeah, ASML is the critical one because they make the lithography machines for the microchips. Their forward guidance is going to either validate this massive AI infrastructure capex shift we saw with IBM, or it's going to cast doubt on it.
So synthesizing all of this, the macro tug-of-war, the IBM capex shift, the gamma box, what is a high-conviction setup, or day 2 play for the active trader tomorrow?
My advice is to recognize that Tuesday was not a trend day. It was a mean reversion digestive day. The probability of unilateral continuation tomorrow is low, under 40%.
Because institutions won't make massive directional bets with ASML and PPI pending.
Right. Keep your position sizing very tight. Expect choppy rotational trading between 7,500 and 7,550. Let those institutional levels dictate the boundaries.
So don't get chopped up in the middle. Just to summarize this incredibly deep dive, we're in a highly bifurcated market. Cool inflation is the gas pedal. Geopolitical risk is the emergency brake. And under the surface, we're seeing ruthless sector rotations to fund this AI hardware supercycle.
And, there's a broader macro implication to that CapEx shift that I really want you, the listener, to ponder tonight.
Yeah, let's hear it.
If enterprises worldwide are completely cannibalizing their traditional software budgets right now, gutting their operational tools to afford these massive AI data centers, what happens to everyday corporate productivity in the near term?
Because those data centers take years to build and actually generate revenue.
Exactly. They take 2, 3, maybe 5 years to pay off. Are we hollowing out current operational efficiency for a future that hasn't arrived yet?
That is a fascinating and honestly slightly terrifying question to leave off on. What happens to the bottom line in those gap years? We will definitely be watching that as the rest of Tech reports this month. Thank you for joining us on this deep dive. Remember, the speedometer might look steady, but the engine is running white hot. Keep your sizing tight, watch the gamma levels, and we will see you next time.